The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
Welcome back to the Option Block, and I hope all of our listeners out there had a fun and exciting weekend. It's another, I guess you can call it mixed day on the street today. Not too much going on in terms of the broad indices, but a lot to discuss from an options perspective in terms of what's been happening and some of the interesting activity we've been seeing out there. My name is Mark Longo, and I am your host for this bi-weekly roundtable through the world of options. I am joined, as usual, by the usual cast of characters, sans one. Starting off with, to my right or to my left, however you virtually want to be, Uncle Mike. It is Uncle Mike Tusaw from Know Your Options, Inc. Uncle Mike, how are you doing this fine, slightly chilly Monday afternoon?
Doing well. I might not be to the right, but I'm definitely not to the left. That I can guarantee.
You're a centrist libertarian with strong democratic leanings and a very strong nationalist bent at the same side. So you fall right in the complete middle of the spectrum.
No, I'm not anywhere. I'm in a different world, I think, in that regard. But I'm definitely not to the left.
And joining us back from his long hiatus, good old Rob Kurzakowski from Options Express. Rob, welcome back to the show. It has been a while.
Yes, it has. I thought you were ducking me for a while. It was the last time I came on. I was doing the show actually with Mike and Joe Cusick. It's certainly been a while.
It's been a while since we've had you back in the core group again. Of course, that was a fun show. Of course, many pieces of it exist only in the ether and in yours and Uncle Mike's memories. But it was still, from what I heard, it was a very, very, very fun show. I'll have to bring Joe back on again in the relatively near future.
And I'm sure he'd love to be on.
Yeah, and of course, we are down a man today. The Greasy Meatball is out actually attending a funeral, so not the kind of place anyone wants to be. I'm sure he'd much rather be here. But with that, with our host cheers complete and the panel ready to go, we will dive right into the trading block.
The Trading Block.
And welcome to the Trading Block. This is the section of the show where we sit down and discuss some of the activity that's moving the markets today, and it was a mixed day on the street. We were up most of the day until right going into the close when the markets took a downward dip. The S&P closed down over 3.5 handles to 1310.19. The Dow closed down almost 23 points to 12,197. And the NASDAQ closed down almost 12.5 points to 2730.68. And the good old VIX cash up 1.43 points to 1934. So a generally mixed day. We saw some strength coming out in the morning with a lot of talk about the possibility of that AT&T T-Mobile deal possibly getting approval or looks like it's getting closer to maybe getting some approval. That boosted the old telecom sector quite a bit, and we saw some boost out of that. We also saw some interesting economic data. Consumer spending posted its biggest increase since October back in February, and also personal income rose as well. So those were two very bullish indicators as well. The savings rate, however, slid to 5.8%. So overall, the data was a little bit mixed on the economic side as well. So that kind of helped boost us today. We also had some interesting housing numbers, which is an interesting one. I've been reading up a little more, seeing some interesting articles on housing lately, because housing these days seems to be one of the most powerful indicators we're getting in the market. The market really seems to move up housing lately. Pending sales of existing homes were up over 2% in February. That surprised average economists and analysts who expected a 0.2% rise, so over 10 times what they were expecting, which that probably plays into our expectation of economics as the dismal science. But, you know, there was some interesting stuff going up this weekend about these housing numbers and how reliable they actually are. You know, a lot of the consensus for housing seems to fall around the numbers from the National Association of Realtors, and they put out their average new home sales and everything else like that. And they use a few different core metrics to analyze what they think is the current supply of housing, as well as the their expected average annual sales rate. And they're starting to see some numbers coming in that differ from the mortgage brokers and other groups that have a key eye on housing, that differ quite a bit from the realtors, and maybe calling into question some of the numbers they use, like their expected annual sales rate. And if those doubts come to pass, then we actually could have a much larger housing supply on our hands than the realtors and our typical numbers tend to expect. So there's a lot of flux going on out there in the marketplace. What were you guys, Rob and Mike, what were you guys watching today, both from your perspectives on the phones, Rob, and with dealing with your clients today? Uncle Mike.
Well, a couple things. The first thing that comes to mind when you're bringing up the housing, I was watching my old house that just sold again, that I sold in 2008. There was a couple bought the house from us, and it was one of the most joyous financial deals of my life, because of the fact that we sold the house for basically break even in the summer of 2008. And that was one of the ones to where, after seeing what went on in the fall of 2008 and just what's happened since then, it's just been, it was a very joyous move, let's say.
Yeah, you got pretty lucky. Not many people can claim that.
It was extremely lucky. And I was just watching it, that same house, it sold again about a week ago, and I did the number, I crunched the numbers on it. It was for a 30% loss from when we sold it. Now, we bought the house in 2005. We sold it in 2008 for, I think it was like a $2,000 profit, roughly break even. We were happier as pigs in slop to get that. And then from 2008 to about 2 weeks ago, it took a 30% hit.
That's an enormous crushing in just not even 3 years. Wow. I mean, that's 30%. Wow.
And I think that's probably why you're seeing the realtors, because they know about kind of like home buyer psychology. You know, home buyers, people that aren't in a rush to get a house, if they see dismal numbers coming out, they're like, well, we can keep on waiting. And at the same time, you have people on the speculative end thinking the same exact way, that they're going to try to cherry pick near the bottom, and maybe we haven't exactly gotten there yet. So maybe those numbers are a little bit inflated by design, as opposed to because of this and this model. Because
they have a vested interest in the outcome? Yeah, I'm always a little dubious when the numbers come from people with a vested economic interest in one way or the other.
Yeah, and you have to, and just to kind of add to it, this house itself, it was on the market for a good 6 months. So, I mean, this wasn't just a we need money right now sale. This was, they tried and tried and tried, and they finally settled at the number that they settled at sale. So that was probably the main thing that really caught my eye. And then just a couple other things that going on in the marketplace today. Not a whole lot. My beloved energy sector pulled back a little bit today. And I see we can talk about, there's some XLE activity that we can talk a little bit more about later on in the program as well. And then commodities, I think it doesn't really look like there was too much going on in the commodity world today. And so, yeah, I think I would agree with you. It was the type of market to where if you can stay awake all day, it wasn't a bad thing. But today was not a lot of activity.
Yeah, I think that consumer spending number was kind of overblown, or the market kind of just yawned when that came out. Tomorrow's consumer confidence number, that's probably what more traders are going to be focused on, because a lot of the consumer spending was, there wasn't a plan to increase their spending. It was everything got more expensive in a hurry last month, and that's why people were spending more. So I think that tomorrow's consumer confidence, I think that's probably why you also saw that little nosedive at the end of trading today, is nobody wants to get in front of that number in case it comes out worse than expected.
Yeah, people closing out their books ahead of it's a very number-heavy week, but we'll get into all that in the around the block section. But yeah, a lot of people wanting to, I'm sure, take some risk off the table ahead of the announcements tomorrow. And I think with that wrap-up, we'll close out the old trading block and roll right into the odd block.
The odd block.
And welcome to the Odd Block. This is the section of the show where we discuss the interesting and or unusual options activity that's lighting up the tape today. And we've got a few interesting ones to parse here today. And we're going to kick things off with the Hartford Financial Services Group, ticker symbol HIG. They closed at $26.58, down 14 cents. And this is a name where we saw a lot of call activity in this insurance name back in my old stomping grounds, Connecticut. And everyone's looking to come in and scoop up calls on the Hartford. We saw some pretty strong trading in the April calls, primarily in the early part of the session. And overall, just through midday and into a little bit later in the session, it was a call-to-put ratio of 35-1 on the Hartford today. So people were loving some calls on Hartford today. Actually, by the close, we saw over 12,000 of the April 28 calls going up today on an open interest of a little over 3,000. So a lot of opening paper coming in today. The bulk of these calls were about over 5,000 were bought for about 43 cents. And obviously these guys looking for a little bit of a pop in the Hartford's numbers. They got to bump up to 28.43, not surprisingly, to break even on these. We also saw some two-sided trading in the April 29s. The bulk of them still coming out on the buying side of the spectrum. The buyers picking up about 2,000 of these calls for about 22 cents. And then, of course, we saw even more excitable bulls on the April 30 strike, where over 5,000 of these, in total of 7,000 on the day of these calls went up. And these are seriously bullish bulls out here on the April 30 strike. Over 3,500 of these were picked up for about 14 cents apiece. These are some serious bulls. Like I said, 35-1 call-to-put ratio on the Hartford, or on Hartford Financial Services Group, I guess as they call themselves now. Not surprisingly, implied vol is up across the board to average about 35% on the day today ahead of all this call buying. Any of you guys watching the Hartford, or any of your customers calling in to trade this one today, Rob?
Yeah, actually, Hartford, we have a customer that it seems like they have very loyal traders, because they're a handful of clients that just they trade a lot of Hartford. It's kind of surprising because it's not really a high beta stock. It's not a really big mover. But I think that's one that maybe has lagged. So you're seeing probably a lot of people that are just kind of given up on maybe trading the stock and moved elsewhere. Previously, we had a lot of covered call buyers. They buy the stock, sell the call, and I think that maybe you're seeing a little bit of shifting between maybe buying the stock and moving that money elsewhere, and just buying options to try to maybe capitalize on an upside move.
Yeah, they've been covered call writers in this name lately. They've been getting hurt. The stock's down a bit since a little bit after earnings. It got a high of around 31, and it's gapped down to about 24 for the past few weeks, and it's come back a little bit since then. Yeah, so these bulls, maybe they're thinking to just get rid of the underlying leg and just pick up the calls. But obviously, regardless of how they're doing it, they're thinking this chart's going to continue the bounce back for Hartford going into. The interesting thing, too, is that this is all front-month activity, so this is very near-term bullish stuff going on in the Hartford right now.
Yeah, I'm looking around on the chains. I'm not seeing a lot of volume in any of the other calls, so this looks like it's, like you said, very front-month.
Yeah, all the activity was April, and this is the name that does lately about 11,000 contracts a day, and it did over almost 31,000 today. And like I said, I don't see any particular fundamental activity that's going on that would drive this, or any news that would drive a lot of this activity. That's surprising to me, though, that you have some regular customers who trade in the Hartford route. And then shifting gears completely to Limelight Networks, Inc. Ticker symbol LLNW. They closed at $6.93, up 36 cents. This is a name that does, on average, about not even 2,000 contracts a day. They did nearly 12,000 today. And what this is essentially a content delivery network for online content. And they got a big spike in activity today over rumors that Facebook is going to be doing a deal with them to stream content onto Facebook. And whenever Facebook is mentioned in association with any other company, needless to say, there's a bump in activity in that company.
Did you hear that Facebook is going to buy Know Your Options?
Yeah. Too bad you guys aren't public. We could have all scooped up some calls on that one today.
Oh, too bad. Oh, just kidding.
It's amazing. Anything that gets mentioned in the same breath as Facebook just automatically gets this huge flood of speculative buying. It's I've been telling people, for the last few months, when you see these valuations for some of these companies, the one that comes to mind is the maker of Mafia Wars and Farmville, Zynga. Where you see the valuation starting to get that high, and you can already start sniffing where the next bubble is going to be, and it's going to be in social networking. I think that people kind of have this association that that it's something that they use on a regular basis, that they're magically going to somehow be profitable, and I think that a lot of people are going to kind of fall into this trap with some of these companies. I mean, it's going to be kind of like the internet bubble. There are going to be some very strong companies that come out ahead, maybe Facebook or a couple of really good companies that actually have a business model, and then you're going to see a lot of these companies just kind of fizzle away.
A business model? What is that? I don't even know what you're talking about here. That has nothing to do with the web. Well, obviously, a lot of people measure the dawn of the internet bubble from the Netscape IPO. And I think you can already argue that we're in a social bubble, but I'm sure looking back someday, the future financial historians will measure either the culmination of the bubble or the beginning of the super strong upside of the bubble is when Facebook eventually goes public. I mean, just looking at all the activity we're seeing in there, whenever Goldman gets involved, they're going to go public, and that's obviously what Goldman thinks. Goldman paid a ridiculous valuation, sure in the knowledge that it could find another sucker on the other end to pay even more. And that usually is the retail public after these IPOs. And just as another aside on Facebook, I've heard that the SEC is already looking at some of these private companies that are handling the share transactions for non-public companies like Facebook, where some of their shareholders can find liquidity. The prints on these very, very small, limited liquidity networks is what's causing these ridiculous valuations. People are seeing the prints going up for a handful of shares and multiplying it by the entire amount of potential float on Facebook and getting these numbers that are absurd, like 50 billion. So that SEC is starting to look into some of these networks as well to see what these prints are that are going up out there and who actually is trading these things and what these prices are. Anyway, with the Facebook talk aside, this name, Limelight Networks, is getting all that Facebook juice transmitted onto them today. We saw a lot of activity in April and May with over 4,000 of the April 7s going up today. Nearly 4,000 of them were done by noon Central, so there was a lot of early activity on this one. So the bulk of these call options were picked up for about 35 cents today, and obviously these guys looking for a nice pop in limelight over the next few weeks. Same thing with the May 7s. This was another popular strike. Over 1,000 of these going up today with about an average price of about 58 cents a piece for those. And these are obviously looking for more upside again by May expiration. Overall, over 9,000 options traded on this name by noon. So a lot of early activity on this one. This call to put ratio is even better than the last one. 49 calls for every put going up on LNW today, or LLNW. So yeah, the Facebook effect rubbing off on LLNW. Shifting gears yet again to Uncle Mike's favorite, good old XLE, the Energy Select Spider. And this one closed at $78.50, down 19 cents. And we're seeing the opposite here, a lot of bearish activity in XLE, primarily in one sizable trade. And overall, that gives us a put-call ratio of 11-1 in the XLE for today. And obviously, this is a very active name. It does about 83,000 contracts a day. A little lighter today, about 68,000 total. So overall, not a super high volume day. But the biggest and most sizable and most interesting transaction we saw on XLE today was actually a sizable put spread. We saw the September 70-77 put spread going up 10,000 times for a net price of $2.33 a contract. So this obviously could play out a number of ways. It could be an outright spec, but when we see positioning like this in September, it looks a lot more like someone has a significant position in the ETF itself, and they're looking to defend some of their recent gains. Is that what you think as well here, Uncle Mike?
You know, as I'm looking at that, XLE has without a doubt had a big run recently, and if you were to just do a speculative play, I agree, it probably would be a more near-term effect. If you're a longer-term investor in XLE and you're looking to just have some type of downside protection, then this is something that might make some sense to you. Now, the other thing that we may want to look at is seeing if there's some covered calls being sold somewhere. Maybe not necessarily today, but maybe in different days. And this could perhaps be a way of legging into the old knockout collar. By doing this, you have protection all the way down to the 70 level on the XLE ETF. So that way, even if you have a 10% pullback, you're still doing okay. And then should we be around that area come September, if you're a long-term bull on XLE, then perhaps you can buy more shares with the profits you took in from the put spread, or just put the money in cash, whatever you'd like to do with it. So I think this does definitely resemble, with this size, as well as with these months, a type of a hedge play by a bigger institution.
You know, when I saw this name and the size of the trade, I immediately thought it was you, Uncle Mike. I was like, this has know your options written all over it. 10,000 lot downside put spread, protecting all those size gains for your clients. This has you all over it, Uncle Mike.
Our clients don't trade that small.
Oh, that's true. My mistake. My apologies to all of the know your options clients.
Yeah.
Turn their nose up at 10,000 lots.
Yeah.
What about you, Rob? You seen any interest in XLE today?
Yeah, we've seen a lot of trade, not only in XLE. XLE is one that's really tends to be popular with the traders that kind of like to condorize and sell a lot of out of the money premium because of the vol. So it's always been really popular. Obviously, lately with the sharp spike and the volatility in oil, it's picked up. I think a lot of traders have kind of been burned out on the actual oil ETFs, the USO, USL, UCO. So we've actually seen a lot more people come back to XLE and OIH in recent weeks, figuring that the trading the actual oil companies, you're probably better off than actually trading the product and getting killed on that contango. So we've seen a lot of activity recently in both the XLE and OIH.
All right, then, and just closing it up with a little name. We've been all over the board today. Energy, we have little content networks, we have insurance, and we're going to close it off with the venerable old name from film world and moving into the digital camera realm, which is, of course, Kodak, Eastman Kodak, ticker symbol EK. They closed at $3.58, up 18 cents, or up 5.3%. And I put this one in the rundown just because it's an interesting one we've been watching for a while. And they've had quite a run today. This is the name. I'm not sure if you guys have been watching Kodak, but like I said, it's a very venerable name. They've been doing well on the digital camera front, surprisingly, even though they had such a monopoly in film. They've weathered that transition relatively well, and yet the stock has just been getting pounded off some poor earnings announcements recently, and it's got down below $3 for a while there. So Eastman Kodak looking very low. And we actually have some residual positions in this that were left over from some puts we had assigned to us. And so we're looking at what to do with it recently. We finally ended up just collaring it off because I didn't want to think about it anymore. And then, of course, they had some news coming out today that some long-standing patent lawsuits they have going back and forth with, I believe, Apple might have turned in their favor. It was looking kind of bad for them for a while. But this is a $1 billion lawsuit that they may actually be getting some traction on. So the stock gapped from 3 to over 4 in the after hours. It was trading, I believe, 4.12 for a while there last night in the after hours. It's since come off a little bit then. So it looks like maybe the death watch for Kodak has been premature. But this is a name that lately has been doing about 14,000 to 15,000 contracts a day. Today did over 75,000. The bulk of that, over 30,000 of those were on the April 4 strike, the April 4 calls. And that activity was very, very much split between buying and selling on that strike. We saw a lot of spreads coming in and legging into selling the April 4 strike. Saw a lot of spreads also buying the April 4 strike. So the activity on that strike was on those calls in particular was relatively mixed. And we saw overall the activity in Kodak today was mixed. We saw a very large percentage of puts being hit on bids, with about 46%, which is very high. But on the flip side, we saw a lot of people hitting calls on bids as well, 45% as well. So the activity was, I think, like I said, in general, mixed. A good spread between people thinking this is the beginning of a turnaround for Kodak and people thinking this is just, a dead cat bounce and the stock's going back below $3 relatively soon. We had net deltas of near short 200,000 on the day, so not a ton of short activity, net short deltas on the day. So yeah, interesting name to watch. It's one we've been watching for a while, and there's obviously potential for a lot of movement in a $3 name like Kodak. I'm sure, Uncle Mike, you guys don't have any play or any interest in Kodak over there, do you?
I used to caddy for the vice president of Kodak 20 years ago. That's about it, though.
So nothing within the last few decades, huh? Do we have any good Uncle Mike caddy stories from that one like you had when you had Dr. Duke on?
No, not from that one. Actually, I do. He was actually also a weightlifter. He could actually bench press close to 300 pounds, too. I actually saw it with my own eyes. So he was a very strong golfer for being an older gentleman.
So in the middle of a round of golf, he would just stop and do some bench presses on the fairway. he would have you carry his weights for him, and then you just set up the bench and do some lifts.
Yeah, I spotted for him too, right next to the green. And then when we really wanted to challenge him, we had him do some bench presses in the sand traps. That was really an interesting sight too.
A strange place you caddied at, Uncle Mike. But yeah, that's going to close it out, I believe, for the odd block today. And with that, we're going to move right into the old Express block.
The Express block, brought to you by Options Express. Options Express lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources, Options Express is the online broker for all traders. Best of all, Options Express allows you to trade stocks, options, and futures all in a single account on powerful yet easy-to-use trading platforms, including mobile devices. Visit optionsexpress.com/OXradio for your free account. Options Express is a member of FINRA, SIPC, and NFA.
And welcome to the Express block. This is the section of the show where I go on hiatus and Uncle Mike takes a nap, and we let Mr. Rob Kurzakowski run amok with the show. So, Mr. Kurzakowski, the reins are yours, sir. Do with them what you will.
Well, it's funny that we mentioned XLE in the odd block because we've had a lot of trading recently and GLD and SLV and other commodity-related ETFs. We've actually seen a lot of liquidation of long call positions, which hasn't necessarily been bearish. We've actually seen a lot of people taking their profits and running on shorter dated options, your April and May options, and actually just going out to January and further out, going up and out, and actually in some cases just taking their profits and just buying options at whatever their original entry point was on these calls, or in some cases just buying more upside options, just a larger number.
So they're not getting out altogether; they're just repositioning for more upside.
Yeah, they're repositioning for more upside, and they're probably expecting a little bit of just choppy sideways trading for a while, and we've seen that like today with commodities, we haven't really seen any giant moves. Just been kind of just like the equity market, just kind of moving along, just slowly grinding, and so you're kind of seeing metal traders really positioning themselves for the longer term, and thinking possibly the second half of the year may not be as at least steady as the first half. On the same token, what we've seen on the equity side has been very mixed. It's been a day traders market. We've seen a lot of traders actually come back to the E-mini S&P. We've probably I've dealt with a lot more relatively new futures customers that in recent weeks, just because the markets have been great traders markets. Intraday we've seen really nice swings, and it's kind of left some of the longer term position traders scratching their heads, just when you think that the bulls are out of the market. We have that correction in the S&P, and we start breaking some key technical levels on the downside. They keep coming back, and they probably will continue coming back as long as the Fed just keeps throwing money out there and printing up cheap money. So for the longer term directional trader, it's been a really mind-boggling few weeks. So it's nice to see that those clients coming back to the future side of the business, because futures, if they're managed well, if you're able to manage your risk, and you're a savvy trader, may not have the resources, may only have 10,000 to put in the account, and can't abide by the pattern day trade rules on the equity side, gives you a lot of opportunities, and with the leverage, we haven't had these crazy, with the exception of what happened with Japan shortly after, where we did have the big down move in the S&P. We've seen maybe anywhere from 15 to 20 point ranges on days where the market's actually moving, which is less than what the day trade margin is at most firms, and so you're not at risk of going debit, and you're not hitting circuit breakers and things like that. So that's mainly the traders that have been really successful the last few weeks that we've seen have been the kind of the futures day traders, or shorter term swing traders that don't get married to a position. And we've actually seen a lot of the trader stocks have seen a little bit less volume. Your Apples, your Googles, Netflix had a really nice day not too long ago, move wise, but relatively speaking, even Netflix and Amazon haven't been as volatile and as we've seen historically. And those are also stocks that people happen to like the call side. So if they have any type of retracement, we really sometimes see those volumes come down a little bit. But I mean, other than that, it's been kind of it's been all over the board here, which is good too, because it's nice to break the monotony on the trade desk and get to talk some different stocks with clients.
You don't want to be talking Netflix and Baidu all day on every call that you do. Now, speaking of futures, obviously there's a lot of interest these days in volatility, and we always discuss the VIX and VIX cash on our show. Do you get a lot of interest on the future side from your clients and actually coming in and actually trading and picking up the underlying VIX future?
We do. Unfortunately, and this is where from a client standpoint, the CBOE CME merger would be great. There's no cross margining. We see a lot of clients come in and they'll trade the VIX and they'll use it to protect their specific options. You can't really use an ETF to hedge yourself unless you really want some huge deviation in performance. The VIX futures have mainly been used as a hedge. I don't think a lot of traders are very comfortable trading volatility as opposed to actually trading a direction. I think on the options side, just because the VIX has been such a popular product for a long time, but it's never made that breakthrough on the futures side.
No, I was chatting with the CFE guys last week, and it's that product. I mean, they're doing better numbers, every month, especially in the last few months. They've had volume records, but yeah, the futures have still yet to catch on the way the options have caught on with all aspects of the market.
I think it's a little bit too abstract of a concept. Well, some days the market sells off hard and the VIX only rallies a little bit. Some day the market breaks a little bit and the VIX rallies a lot. And they don't realize that it's also that the pricing of the VIX is predicated on the options. And so you start throwing all those variables out there, and a lot of commodity traders, they trade indices, they trade a physical commodity where there's supply and demand fundamentals, or they're trading a broad market. And when you start overloading them, and it's also almost like when you're getting a brand new options client that buys a call heading into earnings, and their stock is up, yet their call is down, and then you start breaking down all these variables. And I think that some traders kind of get overwhelmed by the underlying concepts of how the VIX actually moves and what affects the VIX, and the CFE does. They do a great job of putting educational material out there. I just think it's a little bit abstract for a lot of traders. But if we have some good cross margining, down the road, some on a larger scale, I think you may see a major upswing in the amount of trading that you'll see in the VIX futures, just because now you're giving traders a financial incentive to trade the VIX futures as opposed to trading the options. Yeah,
that's true. So when the big CME CBOE deal does happen, that'll be the kick in the pants the VIX futures need.
Yeah.
It's interesting. The talk about futures is always that they're too big a lot of times for retail as well, and CME is having some traction with their mini products they've launched recently, the mini gold and a few others, and the CFE did something similar with their VIX futures a while ago. They launched a mini VIX, and I don't think anyone's ever even heard of it, let alone the fact that if it trades or not. It seems like it's kind of a interesting product that has just completely missed and been overlooked by the broad section of the investing public.
Well, actually, on the future side, when you have a product like that, if there's really good demand, we get we a couple weeks away from the launch, and we get a lot of buzz from our clients where they ask about it. We will add that because that's a pretty good indication. Our client base covers a really wide cross section of traders, so that's a pretty good indication that there's going to be some interest there. If we get one call about it, and we will actually look and see what the actual trading volume is, because we don't want people getting into positions that they can't get out of. And I think that's one of one of our greatest fears is from a risk standpoint. What are we going to do if this guy gets into this position and can't get out of it? It's happened at other places I've been at with the mini energies, with the mini petroleum products, with mini heating oil and mini RBOB, where we've just sat there and had to actually step in and take the other side of a position just because we had to, because we're going into we're going into getting into deficit territory.
Yeah, never a desirable position for the broker to be taken down the other side just to get a client out, or just to provide some liquidity to close out an account.
Yeah, and unfortunately, there are a lot of great products out there. The CME has done that for years. They've come out with ideas that are great in concept, and then they just never take off. I don't know if it's just a marketing thing. Maybe they could be marketed a little bit better, or whether it's you do need big traders to come in and provide liquidity, and sometimes that's what you lack when you launch some of these products. This is a great retail product, but where you're gonna find hedgers and people that can trade this stuff on a large scale that are going to provide a lot of that liquidity as well. I think that's one of the problems with something like the mini VIX, is the large VIX. Floor traders use that to hedge. You'll have traders that have larger complex portfolios that need to hedge, and they'll use the VIX futures to hedge. And you're kind of missing that smaller paper coming in. A product like the mini VIX, you run into the exact opposite problem. It's great for the smaller trader, but where's your big trader going to come in and provide some of this liquidity, because it's just not cost effective for them to be paying transaction costs on all those contracts. Yeah.
That's definitely one of the issues that those guys over at the CFE have to confront. I mean, I'm not sure a lot of people aren't even aware that product exists, so they need to definitely do some legwork on that one. But Rob, I think that's going to do it for the Express block. Thank you for that. And I think with that, we're going to roll right into the strategy block.
The strategy block.
Welcome to the strategy block. This is the section of the show where Uncle Mike takes us on a wonderful journey through the world of options and option strategies. Uncle Mike, what do you have in store for us today?
We have a clinic going on today. We are going to talk about pros and cons of 4 different portfolio/stock hedging methods. We're going to go through each of them.
Wow.
And
let me get my glasses on and let me get my notepad ready.
Are you ready?
Go, sir, go.
All righty. Sounds good. There's a lot when we were talking about today in the odd block in terms of a hedge with XLE, for example, the put spread. Now, I want to go through just 4 various ways with which professionals hedge portfolios, and the ways with which sometimes it can apply to you, the retail crowd that is out there listening. Sometimes it really doesn't make a lot of sense. I just want to go through the pros and cons of each of them so that you at least have a keen awareness on how they work. Now, the first one, let's talk about using a put spread as a hedge. Today we were discussing the 10,000 lot in XLE. And with that, it's a hedge from the standpoint that it's like buying an insurance policy and only insuring yourself with a deductible. Now, there's nothing wrong with that, but just so you kind of have an understanding of it. Let's say that you're buying an insurance policy, whether it's health insurance, disability insurance, homeowners insurance, whatever the case may be, there's always a deductible of some amount. And if there's no deductible, then it's just considered a zero deductible. And what the deductible is when you say that I'll agree to self-insure myself up to $250, up to $500, or whatever the case may be. Now, the higher the deductible, the less the cost is going to be for the insurance policy because you're taking on more and more risk the higher the deductible with which you're willing to take on. Now, it's very important when you're shopping for insurance to find what's the right fit for you. Now, sometimes if you'll notice, you're not going to get that much of a benefit by getting a zero deductible policy as opposed to a $250 policy because the premium will be an extra $246, and it's really not going to be that much of a benefit unless you really know that something bad is going to happen to whatever you're looking to insure. So when doing the put spread as a hedge, what you're looking to take on is just the risk of the deductible and nothing more. In that XLE example, what's going on is someone's willing to take on the risk from 70 to 0, but they're more concerned with a short-term pullback. So the benefit of doing a hedge like that would be if you have a short-term pullback on XLE, it's going to be fine. You have full protection from 77 on down to 70. And that's a very efficient way to hedge so long as XLE does not go below 70. And we oftentimes do hedges like that. The time with which we'll do them is when we have to ask ourselves, what if XLE, and full disclosure, we're not in specifically XLE right now for any of our clients, or we don't have any option positions on that specifically. We do have a lot of energy exposure, but just not in that specific route right now, today as I'm speaking. We have to have the mentality that what if it goes below 70? And if it does go below 70, we have to say, you know what, we're still fine owning it at 70, and we want to just take the 77.70 put spread and perhaps buy more shares with it to have a longer-term bullish view on it, or put the money to use elsewhere. We're fine taking on the risk from 70 to 0 because based on our indicators, it's an okay risk to take. So the pros to that, you have immediate protection on a near-term pullback. The cons, if for some reason XLE comes barreling down to the 50 or 40 level, you're going to have a lot of questions to answer when the clients come a-calling. And they will come a-calling should that happen. Now, let's go through another example, a basic put option. Let's use XLE again as an example. Let's say instead of doing that put spread, we would just want to buy a put option at perhaps the 70 level. Well, if that's the case, it's like an insurance policy in that we're taking on the risk from 77 to 70, and that's our deductible. However, should XLE go to 0, then we have protection from 70 to 0. What are you more concerned with, the short-term pullback or a greater drop in the underlying stock or ETF itself? That's when you have to ask yourself the question, does it make sense to use a put spread or just simply buying a put as some type of a hedging mechanism? Now, another thing that I want to discuss, a lot of times we'll do these in combination with covered calls to create a collar or a collar-like position. We're not even going to go there today. We're just going to talk about the protective downside side of hedging. Now, the third way with which a lot of people like to hedge is with futures. So let's say, for example, that you have a basket of stocks, and the basket of stocks that you have is correlated to the S&P 500. We'll just say, for sake of easy example, that you have a basket of stocks, and you feel that it's an exact correlation to the S&P 500. Now, when you do this, step one, you have to determine how close of a correlation your stock basket is to the S&P 500, because it's almost never going to be exactly to the S&P 500. Otherwise, you might as well just buy SPY or an index fund. But let's just say, for sake of example right now, that we're just going to have an exact correlation to the S&P 500, and we have approximately $65,000 worth of stocks. Well, if that's the case, and you go short an S&P E-mini futures contract, you've basically created an exact hedge, meaning that nothing will happen. If the stock market goes up, for every penny you make on your stocks, you will lose on your E-mini contract. If the market goes lower, then for every penny you lose on your stocks, you'll make on your E-mini contract. That would be the way with which you would use the futures as a hedge. Now, of course, the first thing that I'm willing to bet everyone is saying right now is, well, what's the point? Why would you even bother doing that? The point is when you do have a little bit of a correlation, a lesser correlation, meaning let's say that when the market goes up with my basket of stocks that I've picked, we'll say as the market goes up, my basket of stocks goes up twice as much as the market goes higher. And when the market goes lower, my basket of stocks only goes down the exact same as what the market goes down, because I am just this expert stock picker, we'll say. So if that's the case, then you have an E-mini contract. If the market goes lower, you basically have no risk, assuming the stocks that you pick are just that good that you think that you're picking. However, if the market goes higher, you'll still have a profit in place because of the fact that when your stocks go up, because you're just this great stock picker, your stocks go up in a greater way than the market itself. And that's a lot of times the way with which professionals use futures as a hedge. Now, the final way is the VIX. And I shouldn't say the final way. There's infinite ways with which you can hedge oneself. But a lot of people like to look to the VIX as a hedge. And I want to say right now that for long-term money, if it's in your IRA or something like that, I am not a fan of that. Reason being, a lot of times people are attracted to using VIX options because of the fact that they feel it is a less expensive way to buy put options on the S&P, in that there's the inverse correlation of implied volatility to the S&P 500. So with that, why not just buy calls on the VIX, because the VIX moves up a lot faster than the market goes lower, and you can hedge yourself that way. Most of the time that'll work, except for when it doesn't work. And when you're working with the nest egg section of your portfolio, as we often do, I am not a fan of that. So with that, when would we at Know Your Options use the VIX as a hedge? Occasionally we might consider it like on a pairing trade or something like that. But typically, in the long-term section of the portfolio, we're not fans of using the VIX as a hedge. Don't get me wrong, I like the VIX, the product itself. It has its kinks in it, as we've discussed on this show many times. But as a hedging mechanism, I've said many times I'm not a fan. I think that if you want to buy insurance on your home, you buy homeowners insurance. If you want to buy insurance on your ability to work, you buy disability insurance. If you want to buy insurance on your life, you buy life insurance. I don't think it makes sense to buy life insurance to protect yourself against your home getting damaged. So with that, that is Two Saws, 2 cents for the day on the wonderful world of hedging. Back to you people in the non-mountain region.
Thank you, Uncle Mike, and it was good to have your lesson from on high in the mountains about the various methods and pros and cons of hedging. And with that, we're going to close out today's strategy block and roll right into Around the Block.
Around the Block.
And welcome to Around the Block. This is the section of the show where we talk about what's on our horizon for the next few sessions. And as we alluded to in the trading block, this is indeed an economic data-heavy week. We have a lot of numbers coming out over the next few sessions. We got consumer confidence coming out tomorrow. And as Rob said, a lot of traders probably took their money off the table tonight, hence the small downturn we saw in the market towards the close to get ready for that number tomorrow. We've got crude inventories on Wednesday. I'm sure Uncle Mike and Rob will be watching those with great interest. And then, of course, the biggie non-farm payrolls on Friday. So I imagine that's the bulk of what you guys are watching this week as well.
Yeah, absolutely. I mean, the non-farm number is always the big number. Just to see if we can keep the pace. I mean, we need to create jobs. I mean, the Fed kind of always nitpicks at some of these other figures, the housing and other things, but ultimately comes down to how many people are working, and that takes care of a lot of things: the consumer confidence, the spending and everything else. So yeah, absolutely. It's not as big of an event on the equity side as I remember on the future side. We always had to be in early that day because the E-minis really moving at that point. But that and myself, I'm also watching to see what those Cushing crude oil inventory numbers are looking like, to see if we're starting to get some hoarding going on. I think that some of these commodities have gotten maybe a bit rich, at least when you compare them to their actual fundamentals as of this moment. And I think crude oil is one of those where maybe we're going to see a little bit of hoarding going on, and you're going to see basically Cushing full of crude. But those are the two big reports that I'm watching.
So you think we'll see a little bit of a sell-off in crude after those hoarding numbers come out on Wednesday?
And I think that, this goes back to, I think, last time I was on and talked about this, the contango, that spread between, the near months and the back months. I think it's probably not going to make too much of an impact on your back months, but I think it could possibly send the near-term futures lower, maybe kind of spread get a little bit wider of a contango, and so that's always kind of a unique opportunity because you don't know how long it's going to last, and you don't know how wide that spread is going to get.
Yeah, definitely. We've had a lot of talk lately about crude and just the diversity of opinion and the wide array of open interest we're seeing on the options off things like USO and some of the other names out there. I know ahead of that day of rage a few weeks ago, we were seeing open interest on the 200 strike on the big futures options out there, which is absurd, obviously, but that was all in light of all the rampant media speculation about the $200 per barrel oil after the Saudi Arabia erupted, and obviously that never materialized, and a lot of people threw away a lot of money on upside premium out there. But yeah, oil is definitely one where we're seeing a good diversity of opinion, which I suppose makes for a good trading market for those of you out there who are into the big futures or USO or into the options on the big futures. And good old Uncle Mike, what are you guys watching over at Know Your Options Inc. this week?
Well, a couple things, like you had said, we're watching a lot of the economic news that's coming out. A couple things that are popping out on my screen right now that I think are interesting. The 50-day moving average on the S&P 500. We did pull back a lot at the close today, but it'll be interesting to see with the numbers coming out, if they are bad, if that 50-day moving average holds. So that's one thing that we're looking at. And then another one, the same indicator on Apple. Apple closed above or broke back through the top side of its 50-day moving average on Friday. And we'll be curious to see if it can hold that if things don't go so well in the technology sector. So a couple things from a technical standpoint. And, yeah, just like everyone, we're watching crude and we're watching non-farm this week.
There's been a lot of talk, with Apple. You're right, it has regained a lot of what it had given up over the past month or so. Of course, there's a lot of talk with Apple now that, what the ramifications of this Japan quake and tsunami will be if they can't get supplies for their iPad 2. They're already having a hard time filling orders. I put an order, I think it was about a week ago online, and I was told you have to wait 4 to 5 weeks to buy that shiny new iPad 2. So yeah, they're having trouble meeting demand as it is if this Japan quake and all their infrastructure ramifications come to pass, and they might have an even harder time fulfilling orders.
I was kind of surprised because I thought that some of the rumored specs on the iPad 2 were supposed to be just this thing that blows all the current Android tablets out of the water, and actually the Zoom's probably a little bit better hardware-wise. The two tablets Samsung just announced are probably a little bit better hardware-wise. But I mean, you get a lot more apps with the iPad at this point.
Yeah, I looked. I was hoping that the Android. I was holding out for an Android machine because we have a relatively specific use case of what we do with it here. We do a lot of portable radio, for which a one-handed device like a tablet to hold while you're doing those shows is ideal. But I was holding out hope. Obviously, I'm a Droid X user. I'm an Android fan. I would have liked to have gone the Android route yet again. But when it comes to the actual utility of the device, and I agree with you, the hardware specs on the Zoom are more impressive than some of the other ones. But then the question becomes, what do you do with it? There's 3 or 4 apps right now for Honeycomb, and whereas thousands, if not hundreds of thousands, for the iPad 2. Let alone crazy things like GarageBand, which for portable audio people like us is fantastic on the iPad 2. So there's a lot of reasons why the iPad 2, I agree with you, it was an incremental upgrade, yet it was enough to push us over the edge, and obviously a lot of other people out there too, judging by the lines that are still forming day to day. And all those eager buyers just driving up that price for Uncle Mike and his clients. So it's all a big conspiracy back to Know Your Options, I think.
The pretty big conspiracy, huh?
All right, and that's going to do it for Around the Block as well as this episode of the Option Block. I want to thank my partners in crime for coming on the show yet again. Starting off with you, Mr. K, what is coming up over at Options Express you want to let our listeners know about?
Well, we have quite a few things in the pipeline, and it's actually good because we had a presentation last week with our some of our development people. New positions page is going to be coming out in one of the next site releases. I don't have the exact date. That's going to be very cool. You can pair up your positions. You can try different pairing logics with your spreads if you think that you can get more margin relief. it just there's the order status right on your positions page. So a lot of added functionality. Also, we're going to add some more charting functionality to the all-in-one order form or all-in-one trade ticket. So you can actually pop out a chart right there from your trade ticket if you have a technically sensitive trade and you don't want to trade off the charts themselves. You're trading an option strategy that maybe is not available at the moment. So those two things are in the pipeline. That's it's actually very exciting seeing those in action because they're both very quick. So it'll speed up the web-based site as well.
And I have been playing with the new revised version of Extend, and it definitely is a lot speedier and a lot easier to navigate that UI. So yeah, keep those Extend upgrades coming because I know I like them and I know a lot of our listeners like them as well.
And actually, they're working on a web-based one that just that pops up right out of the platform because a lot of our clients are tied to the website. They love the website. They use streaming. They use streaming quotes. They know Extend is out there and it's a little bit better, but they like having the site and it's a comfort factor. And there's going to be some improvements to Extend itself. You're actually going to, if you have multiple monitors, pop out certain parts of it and put them on different screens. And there's going to be a web-based version of it, so you can pop it up right out of the website.
Well, that's all music to my ears, sir. I'm looking forward to seeing all of that because we like all of that. We like the thin client versions. We like the multiple monitor supports, and all of that sounds pretty good to us. And Uncle Mike, what do you have going on? I believe you're heading to Orlando soon, are you not?
I was actually just in Orlando this past weekend.
Oh, that was this past weekend. Okay.
We were, and we actually had interest. We had, I could say that I have seen an option block listener face to face now. That came to the show.
There is one out.
They exist. It was exciting. He was very excited to be there. It
wasn't Sebastian in some sort of wig trying to fool you or something?
Now that I think about it, the guy did have a beard, so
he was kind of tinny voiced, I bet you.
No, he was a great guy. It was a lot of fun. We had almost 100 people there. It was in Disney World, and it was a lot of fun. So when Options Express comes to your town, folks, it's definitely a show you don't want to miss.
Yeah, I'm not surprised to see the outreach of the show because just gauging by the input we receive on all the various platforms and on our forum and email and everything else, we have a very broad audience. Just judging by last week, we had someone write in from Australia. So the reach of the show is surprisingly large, and whenever you show up to town, Uncle Mike, I expect you'll have quite the gaggle of fans waiting to hear your next bit of advice on collaring.
Well, it's kind of funny. I remember when I was playing with the Bills a few years back, we had this autograph session. This one fan's like, come here, and she was all excited, and so I walk over there, and then she's like, so excited, she's like, Doug Flutie is 10 feet away from you. Can you get me his autograph, please? And it kind of made me think about but nonetheless, it was a fun show, and it was a lot of fun. So, and this weekend, Sunday night on April 3rd, we have a webinar for all of you last-minute tax people. Trading and investing in an IRA. It is not too late to put in your 2010 contributions. And then on Monday night, April 4th, we will have a strike price selection webinar. And for more info on it, feel free to send me an email at miket@knowyouroptionsinc.com.
And speaking of the Greasy Meatball, I should give him a plug as well, even though he is not here. Well, listeners should be sure to surf on over to optionpit.com to check out all of his latest goings-on over there. And, of course, if you want to hear more of the unusual activity or the breaking options news or the analysis or education of any of the other many things we have going on, then just surf on over to theoptionsinsider.com and check it out for yourself. We have quite a few interesting tidbits available there for you to peruse at your leisure. And with that, that's going to close out this episode of The Option Block. I want to thank all of our listeners for downloading and streaming and subscribing to this show all over the world, not just down in Orlando when they want to see Uncle Mike Tusa. And we will see you next time right here on The Option Block.
The Option Block is sponsored by Options Express. When a broker emerges to lead an industry like Options Express, it's only natural to want to join them. Options Express has excelled with powerful technology, an innovative platform, and exceptional customer service. Others wonder what they'll do next. Stocks, options, and futures all in one account. Visit optionsexpress.com/OXradio for your free account. Options and futures involve risk and are not suitable for all investors. Please read the characteristics and risk of standardized options and the risk disclosure statement for futures and options, both available by calling 1-888-280-8020 or visiting www.optionsexpress.com and clicking on the Risks and Policies link. Options Express, Inc. makes no investment recommendations and does not provide financial, tax, or legal advice. The views and opinions expressed on the Option Block are not those of Options Express or the Options Insider Incorporated and are strictly provided for educational and informational purposes only. Any mention of specific stock options, futures, or other investment products is not intended to portray a recommendation to buy or sell a particular security. Options Express Incorporated is a member of FINRA, SIPC, and NFA. Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.